This is part one of a two-part series of short videos highlighting two of the major causes behind the current financial crisis and what we can do about it. As bad as it may seem now, the worst is yet to come. Derivatives and program trading are out of control and devouring world capital markets. Here's what everyone needs to know about derivatives. They are totally artificial financial instruments that allow speculation on the prices of securities that are not actually owned by the person placing the bet. Derivatives are not investing, they're betting, pure and simple. Derivatives have been around for a very long time. By 1610, they'd been outlawed by the Dutch for ravaging that economy. Between 1870 and 1908, derivative trading flourished in the U.S., cheating many small investors. These betting parlors, or fake exchanges, were called bucket shops because the bets were literally placed in buckets. This unregulated speculation on the price movements of securities by people who did not own them contributed significantly to the banking crisis of 1907. The states responded in 1908 by passing anti-bucket shop and anti-gambling laws, outlawing the derivative trading that helped ruin the U.S. economy at the turn of the century. With few exceptions, the vast range of derivatives we see today were illegal throughout most of the 20th century, preventing them from again ravaging our financial markets. Yet in 2000, the U.S. Congress passed the Commodity Futures Modernization Act, a bill that expressly prevents the regulation of most derivative contracts, including credit default swaps. Derivatives have no social or economic value beyond the creation of obscene wealth for Wall Street bankers and hedge funds at the expense of the general investing public. They're just gambling props that go to the extremes in terms of leverage and risk, and only the house wins. Remember, it's a closed system. Every dollar of banker profit comes out of your or my investment dollars. There isn't any money being magically created out of thin air. Since that legislation was passed, derivatives have come back strong, dwarfing equity markets and world GDP. In just 8 short years, derivative trading rocketed to more than 37 times the entire global GDP. That should have everyone alarmed. Yet we've sat back for the past 4 years doing nothing about it, and the problem just keeps getting bigger. Here's what's really scary. Derivatives have already sucked up more than 97% of the available capital in the world. Money tied up in derivatives is non-working capital. It doesn't create infrastructure. It doesn't build homes or cars. It's money tied up in just pure speculation. We're talking about more than $2,200 trillion, and that number continues to climb. Barely 2% of the available capital is still in equities, working capital for innovation, creating jobs, and actually building things. This huge imbalance should cause everyone grave concern and is a major reason why world economies are grinding to a halt. All the working capital has been sucked away for speculation on derivatives. The same effect is draining all the oil out of a running engine. It will grind to a halt. And here's what you need to know about program trading. Program trading routines are funnel clouds that are now horizon to horizon across capital markets, multiplying daily to suck vast sums of money out of our financial systems into the pockets of big Wall Street players. Program trading started in the late 1980s after stock markets became connected electronically and execution became automated. Program trading is nothing more than highly secret logic routines that arbitrage temporary price differences between stock, option, and futures pricing on a particular security across all the exchanges. These routines are developed and controlled by big investment banks and hedge funds, often on stocks they control, and now cause huge daily price swings in the markets. These routines are circular in nature and actually create the arbitrage situations they profit on throughout the trading day, nothing more than shearing the wool off the general public's investment accounts. What's really alarming is that program trading now accounts for 30 to 40% of the daily trade volume on most exchanges, siphoning off huge amounts of your and my retirement wealth. Even more profiteering occurs in the background as huge blocks of stock are moved by these big players outside of the exchanges. Here's the bottom line and why you need to be concerned. Program trading bleeds the economy and gives nothing back. It's just obscene profiteering. The capital markets are a closed system. For Wall Street bankers to make $1, you, me, or the next guy coming in must give up $1. We need to fight back, pull the plug on program trading. The vast overhang of $2 zillion in derivative contracts, 37 times the total world GDP, tying up 97% of the available working capital, is not just the potential, but an almost certain probability of crushing the world economy and sending us into the worst depression in human history. The problem has been allowed to get so large there is little we can now do to prevent what's coming. But there are steps we can take to lower the damage and duration, ensuring a brighter outlook on the far side of this impending disaster. Now is not the time for bickering or finger-pointing. Now is the time for collective action. Banking and capital markets must be brought to heel and re-regulated. We need to reorganize and recapitalize our nation. We can start by immediately terminating all program trading. We need to sharply curtail speculation in derivatives, carefully unwinding the huge overhang of current contracts and making most derivatives illegal once again. We need to constrain the destructive effects of short selling. It drags down too many companies that would have remained viable if speculators hadn't started shorting their stock to drive them out of business. The practice is rampant and has already cost us too many jobs. We need to start making a sharp distinction between speculators and investors. The latter is a good capitalist, the former a bad capitalist. Until we learn to recognize the difference, our way of life is in jeopardy. Recovering the spoils from this obscene profiteering and returning those ill-gotten gains to the pension funds and retirement accounts that were looted over the past 2 decades will need to be the purview of a Congress and court system that actually work for the public's interest, neither of which are in evidence today. In a rational capitalist system, it's still okay to make a profit if it was the result of producing something useful for our society, products, services, or innovations that serve mankind. But simply coming up with a financial scheme to profit from other people's losses shouldn't be condoned. That's not capitalism, it's crime. The spoils from those activities should be clawed back into the working economy, and to the extent possible, provide restitution for those who suffered the losses. This concludes part 1 of this 2-part series. Please join me for part 2, The Road Back to Prosperity. To learn more about the root cause movement or to become involved in the solutions, please visit our website at www.rootcausemovement.com. Thanks for your engagement.